In this video, we're going to talk about the costs that are capitalized when a firm acquires property, plant, and equipment. So you might be thinking, hey, whatever the cost is of a building or of a piece of land or equipment, let's say it's $800 for a piece of equipment, that cost is what's going to become the asset's value when we record that piece of equipment on the balance sheet. And you'd be right, but you can't neglect other costs. For example, let's say there was $50 in shipping and handling to get this machine to your firm. Then the amount that you're going to initially record on the balance sheet is actually going to be $850. So you don't just include the purchase price, that's certainly part of it, but you also include the shipping and handling. And there are a lot of different types of costs that can be involved with property, plant, and equipment when you acquire PP&E. And so I just want to give you an overview of those costs and show you how it would affect your calculations. So let's start with property, with a piece of land. And we're assuming here that this isn't land you just buy for speculative purposes and have no intention of building a warehouse or something there. If that were the case, then the land would be accounted for as an investment, a long-term investment for the firm. We're talking about land where you intend to build a warehouse or a manufacturing plant or something. So the purchase price, the amount you pay for the land, is definitely going to be included in the land's initial asset value, but also any cost to prepare the land for use. And what it means when I talk about preparing the land for use is, let's say there's an old building, right? There might be an old building there that you have to remove in order to build a new building. Right? Or you might have to do grading or clearing of the land and so forth. You're going to incur some costs to be able to build this building. So any cost preparing that land, getting it ready for that new building, those are going to be part of that asset's initial value, of this land's value. If you assume the mortgage of the previous owner, if they had a mortgage, you assume that mortgage, that's also going to increase the capitalized value of the land. That's going to get added to the cost. And then any closing costs associated with the real estate closing, those are going to be part of the asset's value, and any permanent improvements to the land. So let's say that you built a statue on this land, for a statue of the CEO of your company. Okay, well that's a permanent improvement, so whatever the cost of that statue is, it's going to be included along with the purchase price and all these other items in the initial value of the land. Now, if you have any kind of proceeds that you get from salvage, so let's say when you're tearing down this old building, that you sell some of those materials to a scrap yard. Well, that's actually going to reduce the capitalized cost of the land, so that would actually be deducted from the value. So I just want to give you an example and make it a little easier to understand. Let's say that you pay $400,000 for a piece of land, and you're wondering, how much do I put on the balance sheet for? Well, certainly the $400,000 purchase price is going to be part of that. But let's say there are some other things going on. Let's say you had to remove an old building in order to build a new building. Well, that's $250,000 that it costs you to get the wrecking ball out there to get rid of that old building. So that's going to be part of the asset's value. But then when they come out and they destroy the old building, you get some proceeds. You sell some of that material to the scrapyard for $18,000. So that's going to be subtracted from the value. That's going to reduce the capitalized value. And then you have to do grading and clearing of the land to get it ready for a new building. That costs $40,000. So all of these costs are going to be added together with the exception of the proceeds, which is actually subtracted. And the total capitalized cost is $672,000. And again, remember that capitalized means that this is going to be the asset's value. When we talk about something being capitalized, we're talking about making it an asset. And so this is going to be the initial asset value of that land on the balance sheet. Right? So all these things here affect that land's balance sheet value. Now, we're going to talk about buildings, right? So we talk about land, and now let's talk about a building. Let's pretend you're building your own building. Well, the construction costs, obviously those are going to be part of the building's capitalized value, but also any permits or fees. If you've ever tried to build a building, you know that you're going to run into a lot of permits and a lot of fees in order to get that building where you can legally use it, right? So government fees and so forth to build. And all those fees are going to be part of the capitalized cost of the building. And also any professional fees. Let's say, for example, that you hire an architect in order to design the building. The architect fee is going to be part of the capitalized cost. And then also any avoidable interest. Any interest that you could have avoided had you not built this building, that will actually become part of this building's asset value. And I'll make a separate video on how to actually calculate avoidable interest, because it can get a little complex. But just understand that some of the interest costs can actually become part of the asset's value. Now, I want to just walk you through an example. Let's say that it costs $8 million to construct the building. Obviously, that's going to be part of the asset's value initially, but then you pay $500,000 for this architect, so that's going to be added to the building's value, and then $200,000 in avoidable interest. So all of these things together are actually going to combine, and you're going to have the asset value, the balance sheet value, is going to be $8.7 million. We just add all those things together. And so lastly, I want to talk about equipment. So when you purchase equipment, as I talked about in our initial example, you're going to have the purchase price of the equipment, right? So let's say it's a machine, the amount you pay for the machine, obviously that's going to be part of the asset's initial value. But as we discussed, shipping and handling or any insurance you get on the shipping, that's going to be part of the asset's initial value. And then also any costs for assembly, installation, initial test runs, those are all going to be capitalized and become part of the equipment's acquisition asset value.